The U.S. Fed delivered a quarter-point rate cut a day after former U.S. President Trump won a decisive victory in the 2024 election. Join us now to discuss the implications is Alex Gorewicz with TD Asset Management. And Alex, quick question. I'll start off with any surprises for you today?
None from the Fed. They cut interest rates by 25 basis points. It was an it was a unanimous decision. Everybody was in agreement that interest rates need to continue to come down. Balance of risks on really the dual mandate, in other words, labor and inflation, continue to be roughly balanced according to the Fed. And so they believed that continuing on their progress towards the neutral rate remained appropriate despite yesterday's election.
Okay, so now that we have more clarity following the U.S. election, do the results change your outlook on rate cuts?
So the election itself could have implications for interest rates. And I say could because it is highly likely that Republicans have swept the House, the Senate, and obviously Trump's decisive win with the Electoral College, as well as the popular vote. So he feels he has a strong mandate to deliver on the Republican agenda. But we should caution that the House is not yet decided. We don't fully know what the composition will look like, or even if the Republicans will have a majority, although we do guess. In which case, the pro-growth, deregulation, more America-centric policy agenda that we would ascribe to Trump is likely to get passed either in full or some of the key aspects that would impact growth and inflation. And these are important considerations for interest rates, not to mention important considerations for the Fed and how the Fed will take these policy priorities into its forecasts, and how they decide how to react with monetary policy will also be very important to watch, but it's too soon to tell. And then on Fed specifically, we also know in a couple of years that Chair Powell's term will be up in May 2026. And the next chair, how they set the policy priorities for the Fed and what kind of working relationship they'll have with the Trump administration will also determine for interest rate investors, what implications should be priced.
Now, I want to touch on some of those Trump economic policies, which are raising concerns about inflation. Could that prompt the Fed to change course?
What's interesting is, Chair Powell's obviously getting these questions. His reaction is to say, near term, no implications. And now there are two elements that we do need to think about that could have varying timeframe implications for inflation in the US. One is more domestically linked in terms of dynamics around inflation. Another one has global implication. The global side is the easy one. We know Trump favors tariffs on China, tariffs on the rest of the world. But in terms of what's in scope there, how big they will be, how quickly they'll be implemented, we know he could use executive action. So in theory, he could do that from day number one of taking office. All of that is a bit of an unknown at the moment, but that has the potential to increase inflation. And it's, again, not just inflation for the US, but for the rest of the world. So, how the Fed takes that into account, as well as what growth implications there will be from that, is a little bit, we'll call it murky, too soon to say. On a more medium term, and again, this is where the composition of the Senate and the House and the extent to which there is a true Republican sweep will matter on the tax cuts that Trump really pioneered in 2017. It is expected that he will extend those. And that has the potential to really fuel, or rather maintain the strong level of consumption that we've seen from U.S. consumers. U.S. households have pretty clean balance sheets, and to the extent that they can maintain the level of spending that we have seen this year, which has really contributed to the upside surprises on growth, that could have upside surprises both for growth and inflation, which might prompt the Fed to either cut interest rates slower or perhaps stop cutting them altogether at some point next year.
Okay, so I want to talk a little bit about the reaction to the elections by the financial markets. Equity markets got a post-election bounce. Bonds, not so much. What does this tell you about the bond market is seeing?
So it really comes back to the prior question that you asked around inflation and the prospects for, we'll call it, a renewed inflation pressures from the economic agenda. Again, it's important to wait to see how everything gets prioritized, how everything sort of comes into play around that policy agenda. But the bond market is sort of preempting any kind of policy changes. And you are seeing inflation expectations, which are an important component of interest rates, rise. That was the immediate reaction yesterday. It was one of the most consistent reactions across the yield curve, which tells you that investors are saying, I need greater compensation for the risk that the Fed will not be able to meet its 2% inflation target over the medium term. And as bond yields go up, bond prices go down. And so the returns were negative yesterday in bond land.
Okay, so given the Trump victory, what does this potentially mean for the US dollar going forward?
And unfortunately, this is where again, we have to separate the knee-jerk reaction, which saw the U.S. dollar strengthen across the board yesterday versus all major currencies. We have to separate that knee-jerk reaction from the reality of what will happen with inflation in particular, but also how the Fed will respond to potential inflation dynamics, growth dynamics, to the extent that the Fed, for example, no longer cuts interest rates or does so at a slower pace, but other central banks can continue to lower their policy rates. It is very likely that that would put upward pressure on the U.S. dollar vis-a-vis other currencies. But on the flip side, if inflation dynamics start to re-strengthen, if you will, or if disinflation from current levels, which not quite yet at 2%, if there's no more progress on that disinflation, then it is very possible that if the Fed doesn't react by, let's call it tightening its policy stance and rather continues lowering its policy rate, you would actually have the opposite effect on the US dollar. In other words, a weakening. So all of the details matter in terms of understanding the implications for the dollar.
All right, and of course, as we look ahead to the Fed's last decision in December, and the Fed, considers its next move, what will you be watching closely over the next coming weeks?
I think for December, it's probably too soon for them to take into account the Republican policy agenda into their forecasts. December is an important date because we do get updated economic projections, updated forecasts around the labor market, around inflation and growth. So it's more likely that the political or policy agenda rather gets taken into account in March, which will be the next update of economic projections. So by December, I think what will matter a lot more will be the incoming data, right? They have said that meeting by meeting, they are data dependent. Data has come in strong since the September meeting, which is why they dialed down their rate cut to 25 basis points rather than continuing with 50s. So is it possible that they'll deliver another 25 basis point rate cut or not cut at all? Yes, but it will depend on the labor data and on the inflation data that they get between now and the December meeting. And then again, come January and then beyond, the Fed will have better clarity around policy and how that will impact its rate decisions.
Alex, great insight as always. Thanks for joining us.
Thank you, Tony.